Hello and welcome to Moneycontrol special on managing market turns. My guest today is Andrew Holland, CEO, Avendus Capital Alternate Strategies. Thank you so much, Andrew, for joining me on this show today.
Absolutely.
Andrew, we've had a fantastic run in equity markets since 2009 all over the world. Would you see this year as a turning point of sorts for global equity cycle, or is this just a corrective phase that will pass soon?
No, I think it's a turning point in a number of factors. First of all, since 2009, central banks have just been flooding the markets with liquidity, and so for the first time since then, we're actually seeing some tightening. I mean, we've had those kind of taper tantrums, and we've had a few times when central banks have looked to kind of increase interest rates, but it's been very short-lived, and therefore this is the first time you're seeing a real kind of coordinated effort by central banks to kind of tighten liquidity conditions to fight inflation. Now, the thing is that the markets don't like uncertainty, so what they've had before, and you've heard this, I'm sure, many times, is the Federal Reserve put in terms of if markets go down, they'll just reverse what they're doing. But that was in an era of very low inflation and very low interest rates, so it worked for the markets. So this time around, you have very high inflation, and you have obviously the central banks having to tighten, and the only what they're trying to do is try and bring aggregate demand down. Now, in that scenario, where will we land? And I think that's what the market's kind of worried about, is it doesn't know the answer. So at the moment, it's a very messy, not just stock market in terms of the ups and downs and volatility that we're seeing, but also from an economic viewpoint. Are we facing stagflation? Are we facing recession? And I think the market's just trying to work that out at the moment. That's I think the big turning point is, has the central banks globally, first of all, made a misstep by not tightening earlier, by saying inflation was transitory, and now will they make a bigger misstep by tightening at a time when anyway the global economy was kind of pretty soft underneath the stock market. The economy was starting to soften globally, and therefore is that going to send us straight down to that kind of recession type scenario? And that's what the markets are thinking about, and that's why it's a turning point.
Sure. And Andrew, how do you see this, if at all? I mean, these predictions of a recession is going to come to pass. How is this, the circumstances around this time different from all the other recessions that you've seen in the past in the US?
So I think this time, I mean,
because usually there is a feeling that US recession doesn't, linger on for a very long time. You will have about 12 months to 18 months, and then, it's done and dusted, and you are back on, the natural cycle itself is not too long. If at all it comes to pass, do you think it will be a long-drawn episode, or is it something that will have a natural course correction?
No, I think you're correct on the second point. It probably won't be a prolonged recession, and I'll come to the reasons for that. But we're trying to all think about what type of a landing it's going to be. So it's when I said it's messy on the economic viewpoint, it's a bit like when you're on a plane and the captain kind of comes on and says, "Fasten your seatbelts. We're going to go through some turbulence." In that turbulence, the ups are okay, but those downs are a bit kind of gut-wrenching, right? I mean, you kind of go down very quickly. Right. Then you start thinking about, is it a hard landing or a soft landing, right? And that's what I think the Federal Reserve will try and maneuver over the next few months. But here's what's my big concern, is that all of last year, every asset class, from stocks to bonds to cryptos, whatever you wanted, all rose because of liquidity. Now, what's the unintended consequences of tightening? not just by interest rates, but also by reducing the balance sheet. Now, maybe it's playing out in the cryptos already, but is this something that's been swept under the carpet? Maybe the SPACs, the special acquisition companies, maybe there's something out there which we might not like once that comes out from under the carpet. And we've actually been given a trailer of this in terms of what's happened in China. They tightened throughout 2021. What happened? The property market kind of suffered, and then we had those companies, kind of not being able to pay their debts. That could happen in the US. So therefore, the economy goes down a lot quicker, right? Then by the end of the year, and this is a big non-consensus call, we could actually be thinking about deflation, not inflation,
right? Because
consumer demand will fall very rapidly. What will pick us up out of that will be a global capex spending, not the traditional kind of roads and bridges that we all think about, but because of the supply constraints and security reasons, I think countries and companies will look to fill that gap going forward. Now, we know defense is one of them. We know energy is the next. But what other areas? So let's take India. Semiconductors is an area which we have a shortage, right? We don't have any manufacturing.
Right.
So companies or the country or the government will force investment or make investment appealing. So I think it's a big capex cycle globally to fill those security kind of risks in terms of supply, and companies taking the opportunity to fill that gap as well.
Andrew, you talked about unintended consequences, right? So one of the unintended consequences of the liquidity gush has been the wealth effect because of all global asset prices rising. Do you think the Fed will continue to negotiate with the markets because of this potential wealth effect in this scenario, and that itself will create some kind of an equilibrium for the stock markets?
See, you're going back to that kind of Goldilocks scenario again, is that the Fed will think about the markets more than they'll think about inflation and fighting inflation in the very short term. What the Federal Reserve has said, what Jerome Powell has said, is that, listen, there's going to be pain. I'm going to have to cause pain to get inflation where I want it to be over the next 1 year. So therefore, the markets are going to anticipate that, which is what they've been doing, which is that slower growth means slower earnings, means lower PEs, means the market has to correct. So the markets will play that out first until we get to that September, October, time scale where, the markets will be saying, can he go further? Will he go further? Or will he stop now? And
right.
Therefore, the markets will be looking at the forward kind of 12 months. So I think it's more short term. So I don't think he's going to go away and say, I need to protect, the markets. I think that would be another misstep to my mind.
Sure. Andrew, you've been here in the Indian markets for more than 20 years now. The past couple of years seem to have been the best we've had in terms of the strength of the underlying itself, right? Clean balance sheets, economic recovery, and so on. Do you think in terms of market performance itself, we can continue to remain strong this year too? Just in terms of economic performance.
See, the economy is, the good news is that, India is probably, in terms of economic growth, if you compare it either with other emerging markets or developed markets, we're probably in this scenario which I've painted, we're probably in terms of the laundry basket, we're at the top in terms of being cleaner than most and better than most. So I think, our GDP growth will probably be around 7.5%. And, I think that would probably prove to be one of the best globally. When compared to everyone else. And I think we're still in that reopening phase of the economy. We're kind of 6 to 9 months behind what's happened in the developed world. So I think that reopening of the economy is going to play out well in the kind of short to medium term. And obviously the government itself is kind of still keeping its capex cycle going. So I think that will help. But I think the aggregate demand will start to be hit in the next 3 to 4 months, because I think the RBI again will have to increase interest rates. Prices of all goods are going up, as we all know, and therefore, our disposable income will become a lot less on kind of some of the areas which we've been spending on before. So if I take the UK, for example, if you look at the disposable income now, a lot of it's going towards energy bills, food bills, and soon to be higher mortgage costs. So that's the pattern we'll follow here. But I still think that we've got very strong GDP growth compared to the rest of the world.
So where exactly do you see this coming from? Because if you really look at overall aggregate demand or consumption side, we have still slightly short of COVID, pre-COVID times. Perhaps we have bridged the gap by this time, but still it's not, definitely we have not crossed the pre-COVID consumption levels overall. Similarly, the only thing that we have been really optimistic about is public spending and infrastructure, and private capex. Again, you don't see corporates really queuing up to put up capacities even now. At least sentiment wise, it doesn't look like that's happening in a hurry. So where do you see this growth really emerging from?
So it's a very good question, and there's two parts to that. I mean, one is that I think a lot of travel that we used to do outside of India, I think will remain inside India for a lot longer than we expected. So I think that consumption, if you try and book a restaurant at your favorite restaurants in Mumbai or anywhere else, around the country, you have to do it a week in advance. So we know people are out there spending. We can see it. We can, when you go to the shopping malls, you can see it. So I don't think that's going to go away for the next 6 months, because the RBI has only just started on its kind of road of increasing rates. So I think we can still enjoy that part. In terms of the capex cycle, I think what we're seeing is slightly different just at the moment. Is that in those areas where companies want to expand, they're doing it by acquisition. You've seen a lot more acquisitions, a lot more M&A within sectors. I mean, cement's one. We've seen it in in kind of theatres, movie theatres. So I think that's that will lead to more capex once that's been consolidated. But I think the real capex cycle will be in these new areas which are like semiconductors. I think there was an announcement the other day between a couple of companies where they're going to set up a factory. I think you're going to see more and more of this type of capex. It's not your traditional roads and bridges and so forth.
Sure. And in terms of the market cycle, where do you think we are? Because if you really consider, we've been pretty much, in terms of global equities, we've been on an upswing right from 2009. Obviously in 2013, because of the taper, you had some kind of volatility, but otherwise it's been a one-way street for a fairly long time.
So I think the market cycle is probably that kind of that painful part of falling at the moment, where the kind of narrative change from buy on dips to when's the market going to stop falling. I mean, there's a lot of people I meet, I'm sure you do, where they said, oh, I bought this and the stock price went up, and now it's more of when do you think the market's going to stop falling, and when will I be able to get my losses back. But actually, if you look at the market over the last 9 to 12 months, I'm just about Nifty at the moment. It's actually done nothing.
Right.
You've made no money at all.
Right.
So I think for all the SIPs that we look at in a few more months, we will see that we've actually made no money. So if markets are still going through this volatility, then the question we're going to ask ourselves is, well, hold on, interest rates are going up. I get higher returns there, which are less volatile. I have an asset class to go for, which is slightly different than I had when I was working from home. Low interest rates. I had the stock market and I had property. There's only so much property you can buy. So I think retail investor might start to slow down his investments in the markets over the next few months.
Okay. Would you then say that the strong flows that we have seen on the domestic institutional side, will slow down in the next few months? Or are you just talking about direct equities?
I'm probably talking more about direct equities. The SIPs, I think, yeah, we have seen a slight fall, and I think if the markets remain volatile, I think some people will say, "I'll just hold back for my normal monthly, just wait till markets stabilize,
Right.
because I'm not making any money." But on direct, where everyone's been enjoying being a bit of a genius in the markets for the last year and a half. There's been a lot of pain, and there's still a lot more. There's a lot of pain being felt in the markets. So I think that direct investments will go away, and I think one of the things that when people ask me in terms of markets and asset allocation and what should you do, should you be buying the dips? No one ever talks about one thing, which is an asset class called protecting capital.
Right.
So if you were to ask me, Andrew, should I, put some money in the market? And given what I've talked about volatility, just keeping some cash and keeping your capital safe, waiting for when that volatility or when the kind of the problems, are starting to ebb in terms of the kind of, you can see a clearer picture. What happens is that what's wrong with missing the first 5-6% of the market rise? If it's a bigger rise of 30-40% over the next 2 years, what's wrong with that? Don't time the bottom. Protect capital. Right. It's an asset class which it's always best to fight another day, right? Than put your money in, find you've lost some capital, lose confidence. And I think that's what happens quite a lot.
Right. Interesting. So is cash a huge strategy for you? I know you run a long short fund also. So what is your cash level right now? And how do you really play it?
So as you rightly say, we're a long short hedge fund. So what we're trying to do is trying to year after year is get risk adjusted absolute positive returns. That's what we're trying to do. By using hedging or shorting, as you would say. But obviously, part of that strategy is that if I take COVID, for example, that COVID month of March, what did we do? We protected capital. We took the fund to 97% cash, right? I know I'm reasonably old, but I'm not that old that I lived through the first pandemic, right? I don't know how that was going to play out. Now, to my mind, if I don't know how something's going to play out, the first thing to do is say, okay, let's go to cash. Let's see, let's see what happens. Let's see how things start to play out before going back in the markets with our strategies, where we know we can get the returns that we're aiming for. But to try and guess something which you don't know, or you've never experienced before, is just fraught with danger. So, cash is king. Be able to fight for another day, be able to go back into the markets with your capital, kind of still there, is always a great strategy, right?
Right, absolutely. So what is the cash level that you're maintaining right now in your funds?
It's about 60% at the moment.
Okay.
But it's 60% at the moment, but we always have a hedge. Now, the fund itself always has a minimum hedge of 30%, 30.
Okay.
Right. So if you give me 100 rupees today and I fully deploy 100 rupees, I'll be kind of 76 long and 24 short, right? Which is 30% of 76. The hedges at the moment are nearer to 90%.
Okay.
So it's there's very little that's really exposed to the market at the moment.
Right. Understood. So I just want to go back to one of the points that you made earlier about, the direct participation in equities going down from the retail side. And I keep, thinking about this all the time. What we really saw in 2008 was nearly fire sale by FIIs, right? That is what really brought down the market in a very precipitous way. The cut was really, in a very short time period, you saw huge falls in the market, and we had far more greater volatility in Indian markets compared to the US markets. This time, it's been entirely different. for all the FII selling you have seen in the past few months, you've been very well supported by domestic equities. Do you see a point where there could be very solid or a large retail capitulation of sorts, which could lead to something like that? One part of me tells me that that will never happen with retail, simply because of the sunk cost theory, that retail doesn't liquidate. When you see losses, you want to hold on rather than liquidate, as opposed to an institution which will say, hey, things are going bad, we just want to get out and cut your loss and get out. So just that psychological play with retail versus institutions, do you think will play, is that the reason it's playing out differently, or do you expect it to change?
So it's quite interesting. So I'll come back to it in a second, but if you take the US, and again, we always kind of follow with a lag somehow. If you remember a few weeks back, Robinhood, which was, as you know, is a big brokerage there, has actually said the number of investors is trading and actually kind of exiting is increasing day by day, and they've actually had to lay off people there. Zeroda here has said that they're expecting that there'll be lower trading. So you're starting to see it. So my worry is not the people who have been doing the SIPs and the normal regular investments, because they have that discipline and that's good. You might see it kind of ebb off a little bit because of market volatility. It's the people who have been, thinking that markets only have the one way kind of move upwards, and they've been enjoying it across, from large cap to mid cap to small cap. Now, even though our index has done nothing over the last 8 months, small and mid caps haven't. And that's where the pain is, and that's where a lot of the speculation is. As I said, the narratives change from, I bought this and I'm making, it's up 10% today, to when is the market going to start falling? So I think people are worried about, their savings that they've done in direct investments, because there's a reason for it. And the reason for it is usually, I want to buy a house, I want to buy a car, I want to buy a bike, or whatever it might be. And this is the quickest way to do it. And when you've been making money, you increase your bets a little bit more. And then all of a sudden, that turns against you. And then you want to kind of go back to what I was saying is, I need my capital, I need to protect it. So therefore, I'll start selling.
Sure. So, Andrew, what is your favorite hunting ground right now, both on the long side and on the short side?
It's a mixture at the moment, because the market is very volatile. So there's sometimes no place to hide in terms of your long side. Just last few days, if you would have been in metals, you would have done reasonably okay. But then today you would have lost it all again. So I don't think the strategy that we do is obviously very active, and therefore we're trying to protect on the downside when we have days like today, and our hedges will help us there. So what we're trying to do in this scenario is say, what are the sectors which will do well because of this high inflation? Okay, what's the inflation trade? Well, there's only a couple of stocks or sectors that you look at. There's ones with high cash flows. Someone's going to buy. We're all going to buy food, right? At the end of the day, we're going to have to eat, and we're going to have to buy medicines, and so those are your more kind of defensive type sectors. So they will probably fall less in a downward market.
Right.
On the hedging side, you're looking at those sectors which are going to be, really hit by higher interest rates. So it could be companies with high debt. It could be companies. It could be banks, because obviously capex cycle, which you were mentioning, companies are not going to sit on their hands a little bit more and say we don't need to invest. So the banking sector would get hit. Obviously, anything to do with real estate might get hit. So housing finance companies, people again will just kind of sit on the sidelines, or may not be able to pay as quickly. So those are the kind of more negative sectors which will probably fall a lot quicker than your, the kind of more defensive, good cash flow, products which you always will need to have on a day-to-day basis. Now, if I think about that as a kind of a more shorter term, kind of next 3 months, if I go back to my deflation trade at the end of the year, then you could reverse all of that, right? You'd be thinking about banks because interest rates would be stable. If anything, they'd be thinking about falling, and you'd be looking at real estate. So all of that would reverse. So it's all about, Malachi, it's not sometimes about the timing. It's being, sometimes forewarned is forearmed, right? If you're thinking what could happen going forward, then you don't get scared of it. So when it hits, when things start to happen, you'll say, oh my God, inflation's here, right, and interest rates are going up. You actually know that was going to happen. Now you've got to look through that and say, what's next? Yeah. Not in the now, not in the present, but what's going to happen after that? And how bad could it be? Is it reflected in the markets? Is it not? I actually think the markets are reflecting quite a lot of what we're seeing and reading about day to day. My only fear is that of unintended consequences in the next 3 months as they increase rates. Sure.
You're absolutely right, because, even as we try to think ahead, like, Howard Marks talks about, second order thinking, it's just that the markets are so proactive in doing this. I mean, they will discount it far before most people recognize that, right? But that apart, where do you see this inflation trade really? I mean, apart from commodities, and there also you see normally the theory is that when earnings are lofty is when P's are low, and that's like at the top of the cycle, not bottom of the cycle. And if you look at the metal space right now, that's how it looks. But what is your thought?
So my thought is very simple on metals, for example, is that if the whole world is trying to bring down aggregate demand, and inflation is eating into, or higher energy prices, mortgage prices, whatever, eating your disposable income, you're going to require less goods. You're going to buy less cars. You're going to buy less refrigerators and so forth. So the demand for commodities like metals will start to fall, and when it falls, it will be very quick because there'll just be no demand. So at the moment, we're talking about a supply problem. I'm talking about a demand problem going forward. So your supply will start coming on, right? As the bottlenecks get resolved. But when that comes on, demand has now fallen. So therefore, prices will fall. So that's how I look at commodities. It's not on P's at the moment. It's more to do with that demand cycle is going to start hurting, and that will bring down the profitability of those companies, which have enjoyed huge profits over the past year. The one area of commodities like oil, I think will probably remain a little higher for longer. I mean, obviously, Russia, Ukraine doesn't help that factor. But obviously now with Sweden and Finland talking about going to NATO, again, we're not quite sure what Russia's response will be to this. And that could maybe spike up oil prices in the very short term as well, which is not good news, particularly for central bankers. I mean, if you listen to the Bank of England governor the other day, he said, I have no control over inflation.
Sure. So just staying a little bit more on commodities, because one side of the argument is that, this is a structural upturn that you might see because we've not invested in these commodities for a very long time. There is some stuff that has gone away from the Chinese market, or at least not available for the rest of the world. So, so that's the structural story out there. And you also alluded to the fact that, in a deflationary scenario, you will see governments actually investing capexes to ensure that the economies, get pulled up. In that scenario, would you not be arguing a positive case for, a longer, medium to long term for commodities?
Not really, because I think it's going to be, I said, it's not just going to be a traditional kind of roads and bridges that we're building. It's going to be more specialized plants and factories, which probably, doesn't lend itself to So kind of, let's say the L&Ts and BHLs, maybe it's the more Siemens or the ABBs, the more sophisticated kind of smart factories and so forth. So that's where I think the capex cycle is going to go. Okay. More towards, can we produce something here which we have to buy outside? Now, some things you can't, right? The oil we can't, we're still going to have to import. But certain areas we will be able to do that. And I think that's what's going to happen globally, not just for India. So that's where the capex cycle will happen. That's where governments will incentivize companies, or companies will just say, you know what, it's a great opportunity because, with the way we're going with EVs and electric vehicles and everything, there's going to be demand for this product, whether it's a battery or whatever it might be. I'm going to produce it here. I'm not going to be reliant on XYZ country to deliver this for me. And I think, the other turning point for me is what countries are going to, central banks are going to think about in the future. And it's going to be an interesting debate, I think, for the next 6 months, or probably longer, actually, about the fate of the dollar. Because at some point, it will weaken. Now, will it weaken because, countries again or central banks will say, if I look at what happened in Russia, I don't want anyone to be able to take away my assets so quickly. And companies too. Yeah. So I think that's the other thing which will drive the kind of capex cycle. Should India worry about its current account deficit? Should it worry about having so many dollars? Right. Or should it be spending that money in India to grow India going forward? And I think that's going to be the big shift in thinking over the next few years, and that can only bode well, I think, for a country like India. The fact is that whilst I'm sounding kind of a little bit more bleak in the shorter term for global markets, and even our own markets and economy, given the fact that we're a very young country. I mean, millennials and is what 300 million people, similar to China. We know where the consumption demand is going to be. We know the globe knows where it's going to be, and I think once we get through this cycle, I think we're going to see a lot more foreign direct investment, a lot more foreign companies, either through building or buying companies. Will continue to move towards India. Sure.
What is your view on the rupee in the near term, and let's say by the end of this year, where do you think it'll be?
Yeah, so I'm not so worried. I mean, I think I think the RBI, whilst they said they wanted to get a little ahead of the curve, which I'm not sure I completely agree with. I think it's probably more to kind of shore up the rupee in the short term. I think that they're very conscious about import cover, slipping and so forth. So I think that was part of the move, and I think we have to see another at least 100 basis points, a full 1% increase in rates over the next 6 months here. So I think maybe around that 78 to 80 might be the level that we'll kind of move around to, because I think India, as I said before, will still stand out in terms of its growth and potential compared to not just emerging markets but developed markets going forward. So I'm kind of less worried about that in terms of the rupee. And actually, we talk about the rupee a lot, right, about depreciation. But if you're going to take the average over the last 10, 15 years, it's about 3.5% depreciation. What happens is we always have that big blowout, right? When it falls by 7-8%. Yeah. I don't think the RBI will. I think they'll be more considered in terms of trying to let that kind of do it in slow portions rather than one big hit. Right. But it does depend a lot on any of those unintended consequences I talked about, because that would have another risk trade for emerging markets where currencies would be hit quite hard. Right.
So going back to the inflation hedge that you were talking about. So if we leave out commodities, what other stocks and sectors do you see will be good inflation plays? I mean, beneficiaries out of inflation.
I said, I think, when you're playing inflation trades, you're really playing the defensive stocks, right? You're looking at those companies with very strong cash flows, which are repeatable, which is not, year in, year out, they're going to have strong cash flows,
right?
Which will kind of tide them through even fall in demand. I was with an FMCG company the other day, and they were saying that the input prices are virtually doubled across every single part of their kind of input prices. But they're selling things at 5 to 10 rupees. So how much can you really kind of change that end of the market?
Yes.
But of course they're still selling, so they're still getting the cash flow, and that's the key, right? I mean, cash has become king again. Which we haven't been thinking about for a long time, because we've been thinking about all of these new age tech companies and how quickly or how many unicorns we're going to have, right, with no cash flow. At least cash has become king again. And I think that's where investors are heading, or been heading for some time. So it's going to be those which can pay a healthy dividend year in, year out. So that goes back to your cash flow. It's going to be products which you normally will have to buy. I said food and pharma, medicines, and to some extent, IT, because you will have growth in terms of digitization. That's not going to stop. The problem with IT at the moment is not really IT as a sector. It's just that it's associated with technology.
Yeah.
And if you go back to the 2000s, we had that same problem, right? In that anything associated. So even though there's nothing wrong with the companies, it's just association and sentiment will be against them. So you might not see that kind of, they might not be as defensive initially as you would like them to be, like a FMCG or a pharma company.
So, Andrew, again, when you think of defensives, you easily think of consumer staples and pharma, but then if you look at companies at the company level, they have proved to be anything but defensive, especially pharma, right? I mean, whether you look at the earnings trajectory or how their businesses are characterized and how much they are subject to the vagaries of what happens in the US generic space, it's really not, we think it is defensive, but it is not turned out to be defensive. So how do you play that back? And with staples, again, while their cash flows may be protected, the downside seems to be on the valuation front. You don't, most people don't find comfort. So how do you size up the opportunities in the market?
Yeah, I know it's another very tough question you're asking me there. But the way I think about FMCG or staples is this: is that I'm not looking for PE expansion. I'm not looking for that much earnings growth, but I do know that the earnings won't be as bad as everywhere else. See, whilst you've seen, it's food obviously that gets hit the first because, prices go up or you can't pass it on as quick. But the other industries, you're starting to see downgrades now to the forecasts, which you hadn't been seeing before. So those PEs will probably fall a lot more. So whilst you might see, it's all about relative valuations,
right,
and where you can actually kind of protect your capital. And I think FMCG is probably one where you can. Again, you have to be selective on the companies, but
right,
if you just take, say, ITC's results, I mean, they were pretty good, right? We're still going to smoke and we're still going to eat. So therefore, and they pay a high dividend. So that's what you're after. You're after that stability in a very difficult market. With pharma, I'm disappointed too, because, with COVID, I mean, India became the kind of manufacturer for the world, right, of vaccines. And we got put back on the map.
Yeah.
I don't think that's going to go away. I just think that there's maybe a consolidation that needs to happen in India. And I think, again, if I think about the global pharma companies and their exposure to China, India will stand out as an area where they'll probably look to expand more. Now, I think that'll be more through M&A, than it will be starting from a brownfield site and taking years to do it. So I think there's going to be more action on the farmer side going forward. That's my bet. So whilst generics might not be doing that well in the US, I think the potential within India to be a global source of manufacturing, I think because of COVID, has just changed the thinking completely from a foreign investor viewpoint.
Sure. Andrew, how do you look at the financial services space and banks?
This is a tough one, and it's been something that
because that's the only thing that is unaffected. I mean, purely unaffected by inflation. Of course, you can always argue that rates are on the rise, but for a lot of banks, that may not be a big negative because of your ability to keep your cost of funds low, at the same time pass on the cost to the customers and keep the margins intact.
Yeah, that's usually the way it's supposed to be, right? But I don't remember it being that way so easily. I think this is that, first of all, if interest rates are rising, there's a mark-to-market loss on your bond holdings. So that's something that I don't think anyone's taking into account at the moment. Two is, on the private banks, and I'll talk about the private banks in particular, there's been a big shift over the last few years in terms of the top management at each of these banks, whether it's from HDFC to Axis to ICICI. Now, if you go back to 2000, and we talked about IT at that time, your pecking order might have been, if I remember, probably been Infosys, TCS, Wipro, Satyam, and HCL Tech would probably not even be there, right?
Right.
Now, is your pecking order today, as it would have been before, is HDFC Bank still at the top? Is it changing? Because, I think HDFC Bank were blessed with a fantastic leader, right? Helped build that bank. I'm not saying that they don't have processes and the new persons can't do that going forward. But, it's a big change. And there's a big change in other banks who might just take a leap forward ahead of the bank. So I think the pecking order is changing, and I'm not sure how it's going to come out. But what I do know is that at the moment, if people say you should buy, I would buy financials for the deflation trade, not the inflation trade.
But for the pecking order, I mean, the easy answer to that may be just pick all of them up, right? Like you do basket trades. I mean, for commodities, you will buy leveraged and unleveraged. So is that not a good answer?
That's a perfect answer, but it's the opportunity cost. It's the opportunity cost of underperformance in one compared to outperformance in the other. And you've been seeing that big divergence, right, in terms of performance between banks.
Yeah.
For the first time in a long time.
Correct.
Such divergence. And the other area, obviously, is that once you feel that the banking sector is a place to invest again, is the PSU banks, which are incredibly cheap. Probably rightly so at the moment, but if I look at State Bank of India, I mean, I just think of the potential there. Maybe it's always going to be that potential, but it's cheap enough to kind of once you feel that the banking sector is on its up move, then these are a kind of a basket of stocks you can also look at within the banking sector. I also think insurance, health insurance, within the kind of financial sector is going to continue to grow. So will the kind of asset management companies. I mean, yes, they'll be affected by sentiment at the moment, but if we're saying that savings in India is going to continue to rise over a period of time, then asset management companies as well should be part of the portfolio. So all of these will play out. It's all about your opportunity cost of where you want to be right now to what you think is going to happen in the future.
Sure. So again, your thoughts on two things. One, LIC, because it's a recent listing. What do you think of LIC? And second, asset management companies, is the business model itself not becoming weaker in terms of people preferring more money getting into ETFs and indexes, really altering the complexion of profitability and ROE for these companies? and a market in its wisdom has always given very high valuation to these companies, obviously looking at the savings potential and how big it can grow. But if profitability is altered or that profile is altered, do these valuations really give you comfort?
So on LIC, it's an individual stock, so I can't really kind of comment on it. But
Right.
I saw an interesting broker's report the other day, which likened it to an equity ETF. So therefore, if you think markets are going up, then it's a good proxy on that. And I thought that was an interesting analogy to look at. But I think long term, the insurance business will continue to do well. But I'm just not sure insurance is an area in these volatile times which I want to be kind of racing towards at the moment. But it's something which I think is continues to be a very, very high growth industry going forward. In terms of asset management companies, you're correct in terms of that the valuations have been very high and I think that was partly to do with not many asset management companies being listed either. So there's a scarcity value to that. But you're right. I mean, it's a kind of race to the bottom, right? In ETFs, who's going to introduce how many and at what pricing. But if you've noticed that a lot of the asset management companies are now looking at alternatives as a kind of area for growth. Yeah. For example, if you look in the US, I look globally, I think alternatives are about 10% of overall assets under management globally, but about 30% of revenue streams, right? So, and that hasn't kind of ebbed away despite ETFs because it's active management of funds through long short funds or quant funds or whatever it might be. So I think alternatives will be one area for them, and I think the opening of Gift City again could be an area for mutual funds to offer their wares both onshore and be able to get money for investors coming up wanting to invest in India, but also investors wanting to go offshore, so be able to kind of tie up with XYZ for investing in ETFs in the US or directly into stocks in the US as well.
Right. And Andrew, what are you really bearish about? Your best shots in terms of segments or sectors or even stocks you may not want to talk about?
It's a moving kind of strategy actually, because I think that because of global markets, we could have some pain in our kind of large caps. I don't think we've seen that yet, and it would be across the board because just of weightages. So if I had to be bearish, it's more to do with global factors. But those global factors, for example, could impact redemptions in emerging market funds. Now, if you've still got some money on the table in terms of profits in India, which you probably would have compared to other markets, then you're going to sell, and you're going to sell your most liquid stocks, right? You're going to sell whatever's got the highest weightage in your portfolio, and you're going to reduce that. Yes. So I think that's what you've been seeing, and I think that's what we'll continue to see. So even though you might like, say, the banking sector, let's go back to the banking sector, you might be walking up and down escalators because the selling is so high on those stocks that you're just going to lose money. But would I be bearish about it? No, because it's an opportunity. Right. And that's what I'm saying, actually, it's not to kind of say, where can I make money on my shorts? It's how can I protect my capital? How much cash should I have to protect my capital? How much is in the market already? And protecting capital, to my mind, is an asset class in itself. Sure.
Understood. Andrew, if you could just jog your memory and tell us about some of your, experiences in 2000 and 2008. Tell us about some of your mistakes and what did you really learn from them?
Fortunately, I was going back to my Merrill days now in 2003. I just remember it's the same time as SARS, so everything was really bad, right? I mean, we couldn't travel, or people wouldn't travel to India, if I remember it. It wasn't as though SARS, I remember being big in India at the time, but certainly in Asia it was. But the thing about then was that the PE of the market was 8. The broad market. So it was cheap in itself. So then you had that great run to 2008.
Yes.
And nothing could go wrong. And it didn't. I mean, but each year you would see a 10 to 15% fall in the market. You kind of dust yourself down, and then the market would end up higher by the end of the year. So it didn't really matter. So I think the mistake you make is to fall into the, it wasn't the India shining, because that was a yesteryear, but it was the India shining in 2007, 2000. Everything was looking great.
Yeah.
And falling into that, I suppose, by not thinking about some of the global factors around you.
Right.
But the biggest lesson I learned at that time, and how we used it to great effect when COVID happened, was to take, because running a hedge fund at that time in 2008, was to go to cash. And it's a discipline of sitting in cash when you start to see markets rise a little bit, and think, oh, it's all over, things will get back to normal, only to find that the next fall is even worse. Is to just be able to sit and just let the dust settle. And that was the biggest learning I have, is not rushing in and saying, oh, I think this is going to happen, this is going to happen. And I think that's the best lesson I've learned, is not to say, I think this is going to happen, because it's always fraught with something that you haven't thought about. Or, for example, I don't know if you remember in 2008 when markets were really falling, and we're probably near to the bottom, and I can't remember what that level was now in the US. But because stocks had fallen so much, the pension funds in the US had to switch out of bonds, which were seen as a safe haven, and move back into equities to get that ratio, whatever it was, 70-30, 60-40, back in equilibrium from where they were before, because it got too far. The equities were too low and bonds were too high.
Right.
Now, I would never have thought that at the time. It wasn't on my radar to think. So what I'm trying to say is that you don't know sometimes what will help markets to kind of find that bottom, rather than be overly negative. So again, because we weren't taking any kind of big views of where the market's going to fall or go up, you could see that happening. You could then take a view that, yes, the market stabilized. We could see at least a 5 to 10% move over the next few months as the market catches its breath, and hopefully there's no more problems that we were seeing in those days. And that was the real kind of influence, I think, in our thinking going forward.
Right.
In terms of thinking about markets.
Right. One last question, Andrew. How much more to go? How much more correction do you see in the very near term? And by the end of this year, where do you think we'll be?
I'm going to disregard unintended consequences for the second, and I'm going to disregard any escalation in Russia and Ukraine, because that could have either positive or it's going to have a negative impact, right, rather than a positive one. I think there's probably another 5 to 10% globally for markets to fall, potentially. What percentage of would I put against that? I'd probably put kind of a 50-50 at the moment, because the market's still trying to work out where we are. I think India would only fall half of that amount. I'm less bearish on India, to be honest. I do think we're the cleanest shirt in the dirty laundry basket, and I think it's just unfortunate that foreigners or foreign investors are using India as part of their being able to raise funds for redemptions.
Right.
But thereafter, I don't think anyone's saying they don't like India. That's not the problem. Valuations, yes, are a bit challenging, and downgrades still have to happen. But I see that as being more of a 5% fall from where we are.
Sure. Thank you so much, Andrew. It was absolute delight talking to you. Thank you so much.
My pleasure. Thank you very much for having me.